SPY stock, the ETF versus the S&P 500, rallied over the past couple days, all last week, rallying pretty hard. Is this a fundamental move, shift upward? What's going on? Fact is, we've seen interest rates relax a little bit, but interest rates are already on the way back upward. So I wouldn't get too comfortable looking at these moves thinking that we're in this new economic environment where stocks rally. Just the opposite. Because interest rates are as high as they are, stocks need to shift lower on a long-term basis. I wanted to take a look at SPY ETF, SPY stock, and break it down so that you have a better understanding of my viewpoint on what's going to happen with SPY stock. I've been calling for this thing to be moving lower and lower and lower over the past several weeks because higher interest rates will drive companies to earn less. Let me break down SPY stock. We'll show you what I'm looking at so you have a better idea as to what you should be looking at with your own analysis. If you're just joining me for the first time, thanks so much. This channel is a breakaway channel. It's growing quite rapidly. I've only been doing it for a couple weeks now, seeing some great results. Make sure you hit that like and follow button. What I do, stock market analysis and stock options. I break down the basic mechanics of what's happening in the key elements of the broader stock market to include economics. Here we're looking at SPY stock, and as you can see, big rally over the past couple of days, and this really is all driven by interest rates. And one of the things you have to kind of keep in mind when it comes to interest rates is simply this: it's an alternative investment. Interest rates have been so low for so long, no one's been paying attention. Now the opposite is happening. Interest rates are a viable alternative. In fact, the 10-year Treasury is nearly at 5%, which means if you gave the federal government 10 grand, whatever it might be, you're going to get 5%, $500 over the course of the next 10 years. But a better bet is actually the 2-year Treasury note. 2-year Treasury note is roughly 5%. You could give the federal government your 100,000, million, whatever it might be, and you're going to get about 5% over the course of the next 2 years. There's zero downside risk to that. There is the possibility that you didn't time it entirely right. The Federal Reserve may raise interest rates coming up. We'll see how inflation comes in. But how much more do they have to go? Quarter point? Half a point? Because of that, with interest rates moving higher, if the Federal Reserve does push that, the 2-year would be more sensitive to that, price would go lower. But you're locked in for 2 years at 5%. So when you lock that in, you ask yourself this question: will treasuries be even higher yield 2 years from now? We'd have to really see some big shifts with inflation in order for that to happen. I don't see that happening as long as there's no new major wars or whatever, another virus. So your downside risk in getting involved in the 2-year at 5% is not even worth bringing up. But if the Federal Reserve does get in there and lower interest rates, your 2-year Treasury yield is worth a lot more money because yield would go down, price would go up. You'd be able to sell it at profit between now and 2 years. So that's 5%. Now you take your future earnings on any of the stocks coming out there, any of the 500, break down all of the SPY stocks and take a look and ask the question over the course of the next 4 quarters, what would be the yield for any particular stock? Right now for the NASDAQ 100, the yield's about 3.85%. Your downside risk on that is a lot of people are getting out of stocks for a couple reasons. These companies are probably not going to hit their revenue goals because those revenue goals were put together when interest rates were much lower. Consumers are going to be consuming less because they're going to be paying higher interest. So you're going to get companies that are simply going to get less revenue. Plus, they're going to have higher costs. Employee costs are going up and borrowing costs are going up. Revenues are going to be less. Profits will be less. Therefore, stocks will need to adjust. They'll need to adjust to a point where you want to get rewarded for your risk. Otherwise, you're just going to go straight into the Treasury note. This is something that's so fundamental, but no one's had to consider this because the bonds have been in the basement below the basement for years because of COVID, because of the financial crisis and other things. This benchmark investment really hasn't been brought up much because it hasn't been an alternative. Now, it's the biggest thing there is. In fact, with the United States federal deficit, it's getting even more attractive. The deficit's shooting up in a big way. Because of that, yield has to go higher. So you're going to see higher borrowing costs to these companies. You're going to see higher employment costs because employees are demanding more money because of inflation. Those consumers, even though they're getting more money, they're also getting hit with higher interest rates, so consumption goes down. Fundamentally speaking, our economy is going to shift. The revenues projections we've seen for these companies, take a look at any of the SPY stocks, QQQ stock as well. All the revenue projections are going to slowly start whittling lower and lower and lower based on a new economic landscape. Taking a look, here is the NASDAQ 100 earnings per share. I got this out of guru.com. It may be Stock Guru. I don't remember which one it was. I got the data points from there, put together a chart for you. It's actually kind of interesting. This is what earnings per share, all 100 NASDAQ stocks looks like. It's been moving upward over the past several, this goes all the way back to 2011. But here's another chart, year-over-year growth rate. This is one of the charts I like a lot. We've probably peaked in this little mini cycle here. There's really not a lot of reasons for this to shoot higher, that the rate of growth is going to shoot higher. In fact, it'll probably adjust lower. Because of that, stock prices will have to adjust lower. Here, we're looking at the Treasury yield. Again, higher for longer, probably a lot longer than the stock market's willing to wait. They expect interest rates to start dropping next year. I don't. We might see something towards the end of the year. I expect we'll probably see a couple more interest rate movements upward, but no prolonged moves downward. That by and large, the Federal Reserve is going to be somewhat contained. But it really wouldn't matter too much from there, simply because, take a look at this, it's the deficit. As long as that gap between what the government brings in and the tax revenue and what they're spending continues to increase at the pace it's going, like it is right now, this shifts a lot of things. Long end of the yield will move higher. This is a lot of pressure right here. Keep in mind, two key players are no longer in the market. Federal Reserve is no longer buying treasuries as much, if at all. China still consuming treasuries, but not nearly at the same growth rate. Because of that, the long end of the yield curve will remain higher. We'll probably no longer have an inverted yield curve, unfortunately, simply because the long end is going to elevate itself because of too much supply from the U.S. Treasury. This will affect and shift the entire economy. I expect SPY stock to kind of start shifting lower. QQQ stock, of course, as well. These two stocks are going to shift when you look at the alternative, and that investors are going to start selling up their stocks. That's going to trigger sort of an avalanche. Long term, I don't look for this major sell-off. I expect low progressive moves lower and lower and lower for both SPY stock and QQQ stock. The eventuality is that money shifts into the bond market where you get a pretty good alternative investment. So why invest in stocks when there is a better investment with much lower risk? SPY stock, I see SPY stock, the big move we saw upward, I don't see that holding. I see sideways to downward. I see the pressure on the 10-year continuing because of the deficit itself. That's what it is. And from that, SPY stock will continue to sort of melt lower and lower. Eventually, the Federal Reserve might have to raise interest rates a little more if we get more inflation, but they may be close to where they need to be. And then it's a matter of if they lower interest rates, it might be not that much, but the long end of the curve is going to be driven by the deficit and the fact that there's no one buying that debt. Make sure you hit that like and follow button. I continually break down aspects of the stock market that will play into each other Thanks so much. We'll see you in the next video.